Now, our feature presentation.
This one. Hey everybody, welcome back to another Wealth Management Advisory Club meeting, and welcome to Chapter Trace, or Chapter 3 of our Spring Break Workshop Spectacular. This chapter is all about financial literacy. So I did make a comment in Chapter 2 when I did talk about, how this is going to not be like, we talked about if anyone lived in the time that I lived in, like we had freshman financial literacy, sixth grade, we had it. I think we had it like in freshman year, first seminar. It's basically not going to be like that. Trust me. Not going to be like that. So if you guys ready, I know I'm most certainly ready. Let's get this party started, baby. Let's pull up my handy dandy. Okay, let me get this going. Alrighty, and here we go. Alrighty, here we go. Chapter 3, Financial Literacy Workshop here on this beautiful Sunday afternoon we have here today. And here we go. So the agenda for today's workshop, we're going to talk about what is financial literacy, why is it important? And then we're going to talk about the 4 topics of financial literacy, which is budgeting, saving, investing, debt management, and financial planning. Now, I know we talked about probably majority of these things in previous workshops. So again, this one might be a quick one. It might be a refresher one. And again, if you want a full in-depth version of each of these, I highly suggest to go to our bonus meetings because I think those are the ones we've had when we've done management and we did, I believe we did budgeting. If I remember, because I have my iPad. We did budgeting. I think we didn't do anything with budgeting. I know that we didn't do anything with budgeting. We did with investment planning and strategy. So we did do that. So that would be from the 28th meeting on February. Debt management, that was chapter 2, which was previous meeting. So if you guys want to watch that, get a little more in depth about debt management, you can. Financial planning, I really don't think we talked about that. I think we didn't. And then saving, no, we didn't. Okay, so this is going to be fun. And here we go. Let's first talk about what is financial literacy. So financial literacy refers to the knowledge, skills, and understanding that individuals have about financial concepts and practices that are necessary to make informed and effective decisions regarding money matters. So now that I talk about what is financial literacy, now you're probably wondering, wait, why is financial literacy important? Well, it is important for all finance majors, obviously, because if anyone I know we're not all here virtually or in person, but if you're a finance major, you should know these things because sooner or later you're going to have to go apply for a job in this field. So just saying. So financial literacy is important because it enables individuals to make informed and responsible decisions regarding their personal finances. It also equips individuals with the knowledge and skills to manage their finances effectively, to make wise investment decisions. Get it? Wise. Maybe a little bit hint there to our next sponsor we're going to feature in the next couple days. Just saying. To avoid financial scams and frauds and to plan for their future financial security. Financial literacy is also crucial in promoting financial stability and economic growth at the individual and societal levels. Additionally, financial literacy helps individuals to better understand the implications of their financial decisions and how they can impact their overall financial well-being. All that packed all up there we go. Oh, nice. Looking. Sorry that. Oh, there we go. That's perfect. That's what I needed. That is what I needed. Sorry for that. So let's now talk about the 4 financial literacy topics we're going to talk about in this workshop, which are budgeting, saving and investing, debt management, and financial planning. In this workshop, I'm going to touch on all of these in depth. So do not worry. We're going to talk about all of these. And I know that some of it might be a little bit overkill from the last chapter we had and from the other meeting we had in the past. So again, if you want a heavy in-depth look at those, I suggest going back to our archive of meetings on our website, on our YouTube channel, on Rumble, and looking at those. Because again, those are going to be the ones you really want to go heavily in depth on, but I will only give a snippet on some of these topics. So let's first talk about budgeting. So budgeting is important for managing personal finances effectively. It helps individuals to track their income, expenses, and savings to make informed decisions about spending habits. And some of the key benefits of budgeting include the following. Help to set financial goals. Budgeting helps individuals to set financial goals and develop a plan to achieve them. enable better decision making. With the budget, individuals can make informed decisions about their spending, savings, and investment options based on their financial goals and priorities. Help to track spending. Budgeting helps individuals to track their expenses and identify areas where they cut back on unnecessary spending, and helps to avoid debt. Budgeting can help individuals avoid debt by ensuring that they spend within their means and save for unexpected expenses. So again, we did talk about the importance of budgeting when we talked about debt management. So again, just a little snippet of that. So how to create a budget. So I think I did talk about this in the last chapter for our workshop spectacular, but I'm just going to go over probably only one of them, because if you want heavily in depth on the other four, I highly suggest to go to our last chapter. I mean, we have chapter 2, but I only will explain the step 4, because again, it basically, you'll go heavily in depth in step 4, but I will mention the steps, which are determining your income, list your expenses, categorize your expenses, calculate your net income, which to go in depth about that. Basically, subtract your total expenses from the total income to determine your net income. Obviously, this is basically accounting and finance 101. Everyone should know that. Income minus expenses, net income. Very, very easy, very, very straightforward. And then analyze your budget. So now let's talk about some tools for budgeting. So there are a bunch of tools out there, and I think most of us here have used it once in a while. Like, for example, spreadsheet software like Microsoft Excel and Google Sheets. You know, if anyone asks my preference, I really don't mind. I actually am a Renaissance man myself in spreadsheets. So, you know, tell me to do it on Google Sheets, Microsoft Excel, basically make you something. Budgeting apps. So there are several budgeting apps out there available for smartphone and tablets, including Mint, YNABA, You Need a Budget, get it, acronym, and Personal Capital. And there's also online budgeting tools like Every Dollar and Budget Pulse, which allows users to create and track their budget online. And then finally, for those old people, and again, I apologize for calling those people who are watching this old, pen and paper. Back to the good old days. However, I really do not suggest doing pen and paper. I really suggest doing these 3 personally, in my opinion. But again, everyone has their own opinions, so don't comment on that any further. All right. So let's talk about now saving and investing. See, a little piggy bank, you're saving up for a nice sports car or something like that. See, all righty. So let's talk about the importance of saving. Saving and investing are essential tools for achieving financial goals and building long-term wealth. And some of the key benefits of saving and investing include the following. Building wealth. Saving and investing can help individuals build long-term wealth by earning interest on or returns on their money. Achieving financial goals. Saving and investing can help individuals achieve their financial goals, such as buying a home, starting a business, or retiring comfortably, which again, we are going to cover retirement, how to save up for retirement in a future chapter at our WMA Club Spring Break Workshop Spectacular. We're going to talk about that, so be ready for that. And then diversifying income. So investing in different types of assets can help individuals diversify their income streams and reduce their financial risk. And finally, beating the inflation risk. Investing can help individuals beat inflation by earning returns that exceed the rate of inflation. So let's talk about the types of savings account. I probably talked about one of these already, but basically I will go over all of them just in case, but I do want to talk about one of them, and that was the certificate of deposits. If you did remember which workshop it was, leave in the comment section below, and if you do get it right, then you get a little special treat from the WMA Club. A little contest we're going to be doing here. So, so there are several types of savings accounts, which are traditional savings accounts, which are accounts that are offered by banks and credit unions that typically pay a low interest rate. Then you have your high yield savings account, which pay higher interest rates than traditional saving accounts, but often require a higher minimum balance. And they have money market accounts, which are similar to savings accounts, but typically pay higher interest rates and may require a higher minimum balance. May. And the certificate of deposit, CDs. Yes, I wish I had an example of that. Oh wait, I think I do. I think I do actually. To make sure everyone understands what I mean by CDs, not a physical CD, not that, a certificate of deposit. In the finance and accounting, CDs mean certificate of deposits, which are accounts that pay higher interest rates than saving accounts, but require the account holder to keep the money locked up for a set period of time. And there are the types of investments, which again, I am not going to go heavily in depth on all of these because again, if you did watch our investment strategies or planning workshop, I will explain all of those in depth. But just to list them off: stocks, bonds, mutual funds, and ETFs, exchange traded funds. Again, I'm not going to repeat myself. If you want to see the in-depth version of all those, go to that workshop and watch that masterpiece. So in life, there are benefits and risks of doing so. In investing, there are also benefits and risks, which I did talk about all of these in depth, probably more simply the risks with risk management. And I'm not going to cover them all in depth. Want to watch that? Go to our risk management workshop where I talk about those in depth. But investing can offer potential high returns, but also carries risks. Some of the benefits and risks are the following. So the benefits, you have the potential high returns, diversification of income, and the ability to beat inflation. The risks, all the risks I stated on that risk management workshop. So basically market, liquidity, credit, interest rate, and inflation risk. Like I said earlier, if you want to go in depth on all those, go to our risk management workshop. I will explain all those there. So debt management. So this was basically the previous chapter we had for our spring breaks workshop spectacular. So I am probably not going to go heavily in depth on this one because, again, if you want a heavily in depth version on that, go to the previous chapter. Go to chapter 2. Don't just probably skip over this section. That's all I'm saying. But again, there are types of debts, but I really did explain all the types of debt in the debt management workshop. So, which is why I'm going to explain all of them to you right now. So we have credit card debt. So debt owed on a credit card due to purchases, cash advances, or balance transfer. They have personal loans. Loans are taken out for personal reasons, such as consolidating debt or paying such a major expense. They have auto loans. Loans taken out to purchase a vehicle. For example, if you want to buy a Tesla and you don't have enough money to pay for it, you take out an auto loan. As an example, student loans, most actually applicable for all college students. Not me, though. Thank God. So just saying. Loans taken out to pay for education expenses. And then mortgages, loans take out to purchase a home or property. So if you want to buy an apartment or a house, you have to pay mortgage. And believe me, you can ask your parents, they're still paying their mortgages. I guarantee you. All right, so the importance of managing debt. So managing debt is crucial for achieving financial stability and avoiding financial stress. And some of the key benefits of managing them include the following. Reduce financial stress. Effective debt management can help reduce financial stress by ensuring that debt is being paid down in an efficient and timely manner. Improve credit score. Managing debt responsibly can help improve credit scores, make it easier to qualify for loans and credit in the future. And then finally, increase financial flexibility. So managing debt can increase financial flexibility by freeing up money that can be used for savings, investments, or other expenses. And there are some strategies of paying off debt, which I am not going to go over all of them in depth, but there will be one I will talk about a little bit. I'm not going to talk about the snowball or the avalanche or the debt consolidation method, because those you basically can go to the debt management workshop and watch those. Yeah. But what I will talk about is balance transfer. So balance transfer involves transferring high interest credit card balances to a lower interest rate card. And let's talk about credit scores and reports. And do not worry, we are going to talk about this in our maintaining FICO score presentation. Trust me, we will. So credit scores and reports are important tools used by lenders and other financial institutions to assess an individual's credit worthiness. Some key points to note, including, are the following. That credit reports contain information about an individual's credit history, including payment history, outstanding debt, and credit utilization. There also are numerical values that are based on an individual's credit score. Factors that can impact credit scores include payment history, credit utilization, length of credit history, and type of credit they're used. And good credit scores can make it easier to qualify for loans, credit, and other financial products, while poor credit scores can make it more difficult and expensive to do that. And believe me, we're going to talk about that when we talk about FICO score on I believe we'll get the calendar Tuesday. I think it is Tuesday Tuesday. On Tuesday, we will talk about that. All right, financial planning. What that now? So financial planning is the process of setting and achieving financial goals by creating a roadmap for managing finances. And some key reasons why financial planning is important include the following. Improve financial stability. Financial planning can help individuals achieve financial stability by reducing debt, increasing savings, and managing finances efficiently. Goal achievement. Financial planning can help individuals achieve their financial goals, such as buying a home, starting a business, or retiring comfortably. Reduce financial stress. Effective financial planning can help reduce financial stress by providing a clear and actionable plan for managing finances. And finally, increase financial security. Financial planning can increase financial security by ensuring that the individuals are prepared for unexpected expenses or emergencies that might happen. So there are three types of financial goals. There are short-term, medium-term, and long-term. The first one we'll talk about is short-term. Short-term goals are goals that can be achieved in the near future, such as, for example, building an emergency fund or paying off credit card debt. Medium-term goals are goals that are achieved within a few years. So, for example, such as saving for a down payment on a home or starting a business, a startup company. And then finally, long-term goals, which are goals that take many years to achieve. For example, saving up for retirement, which we will talk about that in a future workshop spectacular chapter meeting. We will talk about that, and paying off a mortgage, as an example. So creating a financial plan. These are basically the steps to do in order to create a financial plan. So first of all, set up financial goals. Identify short, medium, and long-term financial goals. Then you want to do is assess the current financial situation of what you're going through right now. So turn your income, your expenses, your debts, and your assets. Create a budget. Not really going to go into depth about that because, again, I already talked about it last chapter. Develop a plan for debt repayment. Prioritize debt repayment and determine a plan to paying off debt. Develop a plan for savings and investing. Determine how much to save and invest each month, and identify appropriate investment options. Consider insurance needs. Evaluate insurance needs and determine appropriate coverage for life, health, life insurance, home insurance, and auto insurance. And yes, we are going to talk about health planning. I think will be Monday. We're going to be talking about it. Oh yeah, actually, it'll be our next chapter for the workshop spectacular. So what do you mean? Put that there. And then review and update regularly. Regularly review and update the financial plan to reflect changes in the financial goals or life circumstances. So the importance of this is reviewing and updating it is important to ensure that it remains relevant and aligned with financial goals. And there's some key reasons why it's important to review and update them is because changes in the financial goals. Financial goals may change over time, and most likely it will. Trust me, it's not going to stay that same way forever. And it's important to adjust the financial plan accordingly. The changes in incomes or expenses, so they can impact the ability to save and invest and may require adjustments to the financial plan. The change in life circumstances. So major life events, for example, marriage, divorce, death, having children, can impact financial goals and require adjustments to the financial plan. And finally, changes in the economy or the financial markets. For example, when Silicon Valley banks went, as an example. Changes in the economy or financial markets can impact the performance of investments and may require adjustments to the financial plan. All right, so to sum this all up in just a couple slides, financial literacy is the ability to understand and effectively manage one's finance. Budgeting is important for managing finances and create a roadmap for achieving financial goals. Saving and investing are important for building wealth and achieving financial stability. Managing debt is crucial for achieving financial stability and reducing financial stress. Financial planning is important to setting and achieving financial goals and improving financial stability. Reviewing and updating financial plans regularly is important to ensure that they remain relevant and aligned with your financial goals. And continued learning and development of financial literacy is important for improving financial decision-making and achieve long-term financial success, which again, I highly encourage all of you guys to do that. If you are an accounting major, I know that we do have sponsors, and for WMA, it could be NJCPA, AICPA, IMA. Get a student membership. I know for NJCPA and AICPA, it's free. IMA, you pay $25 a year as a student. For finance, I think with the CFA Institute, I don't know if they do a student discount. I don't know if someone wants to look into that. They can, but I don't know off the top of my head. So, and the importance of continue learning and developing financial literacy, to go more in depth about that. Financial literacy is a lifelong learning process. So you're going to keep learning financial literacy throughout your whole life. Even while you're still in college right now, you're still going to learn it. And it's important to continually develop and improve financial knowledge and skills. Continued learning and development of financial literacy can help individuals make informed financial decisions and achieve long-term financial success. And keeping up with the changes in the economy and financial markets require ongoing learning and development of financial literacy, which you can actually do by going to Markets Update and Student Managed Investment Fund every 3 to 5 p.m. every Tuesday in the Bloomberg Labs at Dickinson Hall and the Metro Campus, Meyer Center in the Forum Campus, hosted by FDU alumni John Budish and Rich Breyer. Come and join us for all the fun. They'll plug that in there. So yes. All right. And there are additional resources for improving your financial literacy, which I did include in here. So online courses and educational programs such as those offered by Khan Academy, Udemy, and Coursera. I do know for FDU Silberman, and I don't know if this applies for any of the colleges, but FDU Silberman does have a Coursera program. I highly suggest every single business major, even if you're not accounting or finance, regardless, take the course. I guarantee you, you're going to love it and it's going to help you out a lot. Books and publications on personal finance and investing, such as, for example, The Intelligent Investor by Benjamin Graham and The Total Money Makeover by Dave Ramsey. Financial education resources offered by government agencies and nonprofit organizations such as FINRA, which if anyone watched our Wiley presentation, you guys probably know what that is, and the National Endowment for Financial Education, the NEFE. And then finally, financial advisors, certified financial planners or CFPs, can provide personalized advice and guidance on financial planning and investment strategies, which again, most of them have come to WMA Club. So watch all the archives of all of our past meetings to see which ones were CFPs and financial advisors. Mostly all of them, but yeah. Alrighty, and that is the end of chapter 3 of our WMA Club Spring Break Workshop Spectacular. I hope you enjoyed this chapter of our journey here. The next time you guys will see me, which will be tomorrow again, as we will be talking about, as I already talked about it a little bit, is going to be healthcare planning. Yes, healthcare planning can play into effect in wealth management. So until tomorrow, this is Jack saying so long. Have a great rest of your Sunday, and we'll see you on Monday for chapter 4 of our Spring Break Workshop Spectacular. Bye-bye.